All right. Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Good morning to you, sir. Had a little fun this morning with Zoom, so thanks for the patience.
Yep, some technical difficulties throwing up a speed bump, but just a very temporary setback. All is well now. Shout out to help desk at DoubleLine for getting Kimbrough back in the saddle.
Thank you, Aldo.
It's shortly after 10 a.m. Pacific here, November 21st, 2025. Thanksgiving is just around the corner, and we've been experiencing a little bit of indigestion in the market, so to speak. So let's look at the tail of the ticker tape for the week. Currently, we're having a bit of a rebound in stocks today with the S&P 500 up about 1% right now. But on the week, the broad market, as measured by the S&P 500, is down about 2%. The worst performing sector was technology, as there's been some skepticism of the AI animal spirits abound in the marketplace, and we saw a pretty big sell-off, though the major chip manufacturer of the AI revolution posted banner earnings, and that gave a modicum of hope the other day, but the selling pressure kind of continued until today. So very interesting tail of the tape there. The best performing sectors this week were healthcare, up over 2%, and consumer staples, up about 1%. When you look at different measures of equity performance, you look at the S&P 500 equally weighted index, where each stock has the same weight. It was down about 0.5%, so outperforming, the very tech-heavy S&P 500. When you look at the Russell 1000 growth, it was down about 3%, so that makes sense as well. The high flyers are getting hit this week, and the Russell 1000 value down about 70 basis points. So definitely a risk-off scenario in equity land this week. When we go over to the bond market, we've seen a nice rally, actually. Pretty interestingly, though, the best part of the yield curve from a rate rally perspective has been the belly of the interest rate curve, the 5-year point in about 9 basis points week to date, with a 2-year in about 8 basis points week to date. 3-month is down about 4 bips, while the 30-year Treasury only rallied 2 basis points and the 10-year Treasury rallied 7. So kind of in line with DoubleLine's thesis, there's definitely concern regarding the fiscal sustainability of the U.S. government's ability to pay its obligations, and you see that with the 30-year Treasury not really behaving as well as one might expect in a risk-off scenario. But you still had that Treasury performance driving the market higher. If you look at the broad fixed income market, the U.S. aggregate's up about 40 basis points on the week, with the best performing sector, no surprise, being government securities, up a little over 40 basis points. That followed by mortgage-backed securities and invest high-grade corporate bonds, which, have a pretty long interest rate exposure, so they have that sensitivity to rallies in the rate market. The weakest performing sector this week, no surprises, was bank loans, but it was still up about 10 basis points. And we'll round out with high yield corporate bonds or below investment grade corporate bonds up about 20 basis points, and emerging market bonds up about 30. So positive across the board in fixed income land, though I will say there's definitely a bit of fear in the credit space. And it seems like there's been a few blow-ups that are giving investors concern if there are dangers lurking out there. And we're definitely aware of that at DoubleLine, and we're taking a very conservative approach because we ourselves are wary of, maybe some lower credit rating credit rating standards in the private credit space that could materialize in the next downturn, whenever that may be. Shifting gears to the commodity space, on a week-to-date basis, the broad commodity market, as measured by the BCOM, was down about 1.25%. And when you look at the composition there, the big loser was the energy sector, down about 2.5%, followed by industrial metals, down about 1.75%. Even precious metals lost a bit of their luster, down about 0.5%. So negative weakening in the commodity space. Currently, WTI crude oil is trading at about $57.80 a barrel, and that's just indicative of the high supply market we're in, with questionable robustness and demand growth. Demand growth is projected to be, positive, but it's being outwashed by the supply that is in the market currently. Copper down about 70 basis points on the week, and rounding it out with everybody's favorite pet rock, gold, actually is let's just call it flat on the week. Currently $4,085 a troy ounce, but not a big rally, but not a big sell off either. So we'll just call that flat. But the kind of big news for all the speculators out there is the crypto markets have been experiencing quite the drawdown. Bitcoin down 11% on the week and currently trading, as we're speaking right now, spot Bitcoin is at $83,800 a Bitcoin. It bottomed out close to 80,000 earlier this morning. It's rallied back a bit, but we're going to have to watch how that closes and how it trades going forward. There's the Bitcoin speculators who believe in the Bitcoin halving cycles. If that pattern repeats itself, where every 4 years it kind of halves, you'd expect Bitcoin to drop down to the 60,000 range. I'm not predicting that. I'm just giving that as information for those that are watching this market. Definitely at a key support level right now, and we're going to have to watch the ticker tape to see if it's able to hold. And that kind of rounds out the markets for the week. Pretty exciting. A lot of volatility, but fixed income has really delivered ballast to investors' portfolios, and that kind of rounds us out. Do you have any different perspectives, Mr. Kimbrough?
No, I'm pretty aligned with that. I do want to point out it's been we were talking about a couple. You mentioned technical levels. Yesterday we were on the desk talking about the S&P, and it ran into a couple different technical levels. The S&P has been falling since the FOMC meeting. That was the local peak on October 29th. But we had some local lows happening in October as well as in November, and we were sitting right around that same level, which was sitting right around where the 100 daily moving average was. And the market kind of sat there, and it was kind of scary seeing where we'd open today. And it was nice that we had Williams kind of maybe give a little extra support to, optionality of rate cuts or whatnot, that maybe that helps support or buoy the market a little bit, and seems to have given some support again at that 100-day moving average on the S&P. So we'll see how that is digested in the week to come.
Yeah, I mean, I think that's an important point to bring up. The Fed President Williams came out today and said in the near term, he wouldn't be surprised if rates, could go lower, and that naturally cause a repricing at the front of the interest rate curve. And speculators now think that there's about a 2/3 chance of a 25 basis point cut at the December meeting. That will be coming up on December 10th, and that's because the labor market has been weak. And you saw that kind of with the September jobs print, and you'll get into all of these kind of delayed data sources that are dropping. But I think the big picture point to keep in mind is the data is questionable because of all the holes and gaps because of the government shutdown, and the picture that is being painted is of a labor market that's definitely not in a growth stage. It's just kind of clinging on, and I think that that's kind of the motivation there for Williams. The cynics out there will say, well, yeah, the stock market was dropping a few percent, and that catalyzed Jay Powell to tap him on the shoulder. We'll see what happens, but that's definitely an important data point. So let's kind of roll into the economic macro data for the week.
We've got data. This is nice. It's really it's exciting to finally get this back again, even though it is quite stale. Let's jump right into it here. Tuesday, still stale data. We had import prices and industrial production for October, not released, although we do expect the September import price data to be released on December 3rd. Moving forward to Wednesday, we had the FOMC meeting minutes get released. Look, just want to focus on two things in general from the participants section here, and it's the Fed's dual mandate. We have inflation and we've got employment. On the inflation side, you've got a split camp, and this is all stuff that was talked about in the press conference, but you've got several participants who are saying that if you set aside the impacts of tariffs, we're approaching the Fed's target. I remember Powell last at the press conference said maybe 2.3 to 2.4% on core PCE. if you were to back out the effects of tariffs. But on the other hand, you have more participants. It said several had one opinion of maybe, inflation is not too bad versus many participants said inflation is above target. It's been there for some time, and they're not seeing signs of it returning sustainably to 2%. So you've again got that tension going on over the inflation mandate. When it comes to the labor market, everyone, it seems like, is in some agreement that the risks to the labor market are rising. I'm going to actually just a general characterize this report is you have many people, I would say many people think inflation's too high. Many people think the labor market risks are rising. And so as we get this data, I mean, it's going to be challenging for the Fed to, figure out how to deal with this tension and for Powell to create a consensus at the next meeting coming up in December. Moving forward, we have initial jobless claims. We finally got all the backfilled data. I'll summarize that and give you what we got for this week or for the week ending November 15th. The most recent print came out at 220,000. That was 7K below estimates and 8K below the prior. Over the last couple months, we've been missing this data. The initial claims came through in a range of 220K to 235K. So this print was on the lower edge. The peak actually we had was October 3rd, so quite a ways away. 4-week moving average at 224K. I'm going to say from initial claims perspective, now that we got all the backfilled data, it's a bit of a steady as she drifts. No real change on that high frequency data, but that is not the same for continuing claims. We got continuing claims the week ending November 8th. That came in at 1.974 million. That is a new local high, a post-COVID high, which also helped carry the 4-week moving average up to 1.960 million, another post-COVID high. Looking at this data over time of the last couple of years, continuing claims has appeared to move in regimes. It'll plateau for a while and then phase shift up, plateau for a while. And now that we've gotten this data backfilled, the plateau we've kind of been sitting in for the last 6 months looks like it has a chance of maybe breaking up to a new level. This would all be indicative or would be supportive of, the ongoing loosening of the labor market or the ongoing weakening in the labor market. So I'll say that is what continuing claims are suggesting here. But we got better labor data, again, very old, but we got the establishment and the household survey data for the month of September. We got non-farm payrolls. Again, very stale data here. The October report has been canceled by the BLS. The November report is scheduled to be released on December 16th. Unfortunately, that will come after the next FOMC meeting, so they'll be flying a little blind on this labor data. But let's dig into these numbers here. Again, very old, so we'll do it briefly, but non-farm payrolls came in at a nice 119K versus a 4K prior. Look, you can split this and say there's something for the Bulls, something for the Bears. It's a nice print to see. Over the last 4 months, we were averaging just under 19K per month, and now we got 119K. But the vast majority of those jobs came in two sectors. It was education and health services and leisure and hospitality. Would prefer a more broad-based job growth if we were truly to get excited about this number. There's one other number in there to mention. Construction jobs had a 1-year high gain of 19,000, although that kind of just offsets the prior 3-month loss of 19,000. So I'm going to say all in all, decent report for the establishment survey. Not great, but it's, look, it's better than the weak numbers we'll see, but this is one data point. We need to see future ones. And unfortunately we won't get the October print. And as you mentioned, this is all kind of muddy.
On that point of the October print, I know we're not going to get it. It's lost to history. Never going to see it. But, there's speculators on Wall Street, various investment banks and private parties trying to do their own kind of data analysis. And there was speculation that some of the deferred layoffs due to the Doge movement, where government workers were basically paid, 6-8 months of compensation to quit, we're going to hit in October, and that could have led to a big negative print. That's a speculation, and we're never going to know, but there are some forecasters out there who think that the October print was going to be a pretty nasty report.
Oh, that's definitely important information there. I mean, you know what? That also is a reminder of why, and this is something Powell's mentioned, we should keep more of a focus right now on the household survey, the U3 rates. Getting a little noise when you're trying to compare over time with the difference in the labor market now versus a year ago or in years past. But let's move forward then to the household survey. We got the U3 and U6 labor participation rates for September. Same story here. October report is not going to ever get released. We'll get the November after the FOMC. The U3 rate came in at 4.4%. This was 0.1% above estimates and the prior. The labor force participation rate came in at 62.4%. That's also 0.1% above the estimates and the prior. And finally, the U6 rate, the underemployment rate, came in at 8.0%. It was actually 0.1% under the prior. Interesting report here, actually. This is like the U3 rate is a new local high, suggests, ongoing weakness in the labor market. But the other two data points are kind of swimming the opposite direction here. Participation rate ticked up from the prior. It's not any sort of high. It's off the lows of 62.2 that we saw in July. But it's a bit interesting, actually. It's very odd looking at the history of U6 and U3 to have the U3 rate rising and the U6 rate falling. As a reminder, the U6 rate, this is the underemployment rate. This takes the U3, the unemployment, and adds discouraged workers, marginally attached workers, and part-time workers. It's basically people who've been searching for a job and kind of just given up for one reason or the other, whether they're just kind of giving up for now or they don't think their skills match the workforce. And the U6 improving actually shows that you had an increase maybe in people moving from part-time to full-time jobs. The numbers reflect that. We had a 673,000 increase in full-time jobs this month, while part-time jobs decreased by 573,000. It also shows people re-engaging with the labor force. That is the labor force participation rate increasing. You have the population growth by 225K, but the labor force more than doubled that. So a mixed bag here in terms of this. It still suggests a weakening labor force, but it is nice to see maybe an improvement in the quality of jobs from this month, and that people are, moving from part-time to full-time and are actually re-engaging with the labor market. So I'll call it a mixed bag, nothing that really would push the Fed in one direction or the other. And you know what? Let's wrap it up here. We got today. We'll do this very briefly. The S&P Global U.S. PMI data for November. This is prelim. Manufacturing, all metrics stay in expansion territory. Manufacturing kind of trending back towards the 50 bound, but still came in at 51.9. Services at 55. The back half of the year, it's actually the second highest print this year. The services are looking stronger in the back half versus the first half of the year. And the composite number also looking strong at 54.8. Look, the 3 points here I'll mention. The first is a quick summary from the chief economist there, who mentioned that so far the composite data we've gotten is indicative of annualized GDP for the fourth quarter of about 2.5% so far. So, firm from the GDP perspective, from this report's perspective. But the other two, I want to focus kind of bringing it back to what we got from the FOMC, from the labor data we're getting, and hopefully the inflation data that's going to come through. Employment in this report was noted to continue to expand, rising for 11 of the past 12 months. There was a bit of a pickup in manufacturing hiring, faster rate in the last 3 months, but service hiring did decelerate. So not a whole lot there. We know employment is kind of trying to hang in there, but gradually weakening. But inflation, I thought this was the most important part of the report. There's a bit of a divergence here between manufacturing and services, what this report suggests for their inflation experiences. On the manufacturing side, it reflected an input price growth that continues to moderate, even if it's still elevated. This was the lowest print we've had since February this year for input price growth, and that allowed output prices, their selling prices, to continue to moderate. Again, still elevated, but at least moderating. On the services side, it went the other way, though. We had input price growth taking a jump to the highest level since Jan of 2023. This led into selling price inflation picking up this month, although the report does make note that increased competition, some competitive pressures going on in the service industry, is restraining pricing power, and it's keeping the prices below the recent peaks that we saw earlier this year. So, all in all, decent PMI data, but that wraps up our first week of robust economic data for the most part, even though it's a lot of stale data.
Yeah, I mean, that was a good overview, Mr. Kimbrough. Like you said, some of that data is archaic, in the current market, but we got to go over it and at least see what it's saying, especially in light of the fact that October is just going to be a bit of a gaping hole there in the data series. We mentioned briefly the kind of the chances of a cut. I will say, even though the market is thinking there's a 2/3 chance of a cut at the December meeting, I think it's still important to say that it's really up in the air. It's probably more of just a coin flip, and it's going to be highly dependent on how the market reacts over the next few weeks and any of these data bits that come out over the next few weeks that can kind of give insight into what's happening, whether that's initial jobless claims, etc. So with that, let's kind of give a brief overview of what we have to look for on Thanksgiving week. Should be a pretty brief week, even though there's a lot of data points. You never know, a lot of market participants might be out for the holiday, but definitely some prints to highlight.
Yeah, let's jump into these here. I'll blow this back up on my screen. I can't read my screen at that size. So we start the week off. Unfortunately, we're getting some missing data, but we're supposed to get retail sales all the way back from September. Very stale data. We're supposed to get on Tuesday the PPI data from September. No estimates on this. I don't know if people are scared to do so, but yeah, that's where we're at now. On Tuesday, we also get S&P totality, home price appreciation or depreciation numbers. We'll find out. The most recent print on the year over year was 1.58% for the 20 city measure and 1.51 for the national. Also on Tuesday, quite a deluge of data on Tuesday. We get the Conference Board consumer confidence number for November. This is estimated to come in at 93.3, one of the rare estimates on the week. It would keep us above the April low when the tariff tantrum was occurring with the Liberation Day and all that, but it would be the second lowest print if this estimate came to be since Jan of 2021. So not looking great on the confidence side. Moving forward to Wednesday, trying to get this data in before Thanksgiving. We get initial jobless claims, continuing claims. Also, durable goods, finally expected to get the September data. Again, very stale, but nice to get it. And lastly, on Wednesday, we'll get the final release of the Beige Book, the 8th of 8 releases, with some good qualitative data there for review. And nothing of note on Friday. It's Thursday. Happy Thanksgiving. And yeah, that would wrap up the week on deck.
Yeah, that's definitely a bit of a light week. Yes, we're getting some of those backfilled data prints, but I don't think they're the most important pieces of information to come out. The initial jobless claims will be the most important piece to come out, but relatively quiet week. And that wraps it up for this episode of DoubleLine Minutes.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. And, the CEO of DoubleLine, Jeffrey Gunlock, was on Fox Business with Mr. Payne. So I think that you got to check that out. It's an interesting interview. And I hope everybody has a great Thanksgiving. Enjoy a little turkey if that's your thing. If it isn't, get something else that you enjoy eating. We're going to be taking the week off next week, so please tune in December 5th for the next episode of DoubleLine Minutes.
Yeah, thanks everybody, and enjoy your time with friends and family, and stay safe. It's Thanksgiving.